Hi, folks. Welcome to the Weekend Investing Daily Bite of 31st of July. Please read the disclaimer fully, understand it, and only then move forward in the video. Today's topic of discussion is discount nahi mila kya? So, a very interesting topic. Let's see what we have in store for you. So, in India, we don't just love a good deal, we are conditioned to chase one, and that is so commonplace. You can see this lady is bargaining for a 50 rupee discount on a 1200 rupee sari. So from Sabji Mandis to real estate, from Flipkart to Big Bazaar, we've grown up believing that getting something cheap means being smart. So the first lessons we learn as Indians is never pay full price for anything. This habit doesn't stop at clothes or groceries; it enters the stock market also. So now, it's cases where stocks have doubled. We feel it is too late. I'll buy it when it dips. Why pay so much for it now? It is already up 80%. You can't fool me. This stock was worth 10 rupees and now it is at 20. So we believe that if the price is rising, it must be overpriced. So this concept is ingrained into our mind that if we have seen a certain price and if the stock is above that, then something has gone wrong. It should come back to that price. I should be able to buy it at that price. But the market actually doesn't listen to anybody. So, for instance, I remember the DMart IPO somewhere opened near about 500 rupees, was of course looking very expensive as per the most of the analysts. But then it suddenly doubled from there. And then people said, it just can't go anywhere more. It was already expensive at 500 and now we are at 1000. uh, and then in just 4 years from its IPO, it reached perhaps 10x. Going from 500 to more than 5,000 in the next few years. So at every point, it felt it is too much, and yet for those 3 4 years, it just continued to go up. Another case was Kochi shipyard, which had been languishing for a long period of time, and then recently in 2023, it broke out from its previous highs, and it seemed that it's already gone up 100% in the last 1 year. It's a sarkari company. Where will it go now? In the next couple of years, 20x returns from there. That kind of a move came through. So this discomfort with rising prices or high prices is not logical. It is mostly psychological. When you actually start to trace the path of stocks that are hitting new highs, you will find that a significant number of them actually go much higher. So it is this vertigo is in our mind that if we buy a stock that has moved somewhat, then it is perhaps worth waiting or perhaps worth not buying it at all. On the contrary, the stock actually which moves is telling you that you know it has some wind behind it. There is some force now that the price is moving, and that force is not just that for few days. It can perhaps extend for long periods of time, as more and more people discover what the magic in that company has changed. So this is basically a bias issue, a very very powerful and invisible bias we carry. Is We call it the anti momentum mind or anti momentum mind, whichever way you want to call it. The bias that makes us uncomfortable with high prices, and it makes us exit too early or never enter at all. So even if we were to enter a stock that is going up, the price movement makes some fearful thoughts in our mind, and we get out in 10%, 20%, 30% kind of moves. कि बहुत हो गया. This बहुत हो गया, we decide in our own mind by ourselves. uh, or I'll wait for the stock to come back to the original price. So this has to do with some cultural conditioning, uh, which is there to wait for sales, ask for discounts, hunt for the cheapest options. We celebrate, buying value. All that is conditioned very well into our minds. Whereas in the market reality is that the strongest performers are often those that are already going up. You pick up any year of the market, the best performers will be, you know, the ones that have that started running up at high valuations also. Uh, Current leaders, the stocks that are in focus, in play, where smart money is playing, will never slump down for you to enter easily. See, one thing we need to make very clear in our mind is that we are a small fish in a very large ocean which is full of big sharks. And we, as an individual, cannot beat that entire ecosystem. Once in a blue moon, yes, luck may favor us. But in general, if there is an opportunity, there are enough sharks in the market to take that away. So this mind frame or mindset that, you know, I think the stock is worth 10 rupees, so it should come to 10 rupees, I think that is not worth it. Current leaders, where the trend is there, where funds are flowing, will not come down on sale to your price. Waiting for a dip often means missing the run. Sometimes I even know folks who will, let's say, who have decided that I want to buy a stock that is going up. Stock has gone from 10 rupees to 40 rupees, and they say, okay, fine, I know I can see the stock going to 100 rupees also. But then at 40, there's a bid at 40 and a offer at 41. They will bid at 40 and wait for 2 days and find the third day the stock is in circuit at 45. So those kind of mind frames are also there, that although I'm willing to pay 4x more than what it was 2 weeks back, but now I want this 1 rupee discount at the buy. So why do these biases exist? Let's discuss four issues. First is that we believe success cannot originate from a point of expensiveness. But when it originates from a point of being cheap, we tend to embrace it and accept it. So, if somebody would have bought Yes Bank at this huge drawdown in 2014, I mean, that's a celebration point that, 35 rupees I've been able to buy Yes Bank. Stock has gone up 10x. Perhaps that person never sold it, and now after 10 years, we are still at 19 rupees. But nobody will talk about that. But that catching the bottom or catching the top also sometimes becomes like a feather in your cap. Uh, a momentum strategy perhaps would have bought at 125, got out at 250, never looked at the stock again. Nothing exciting there as of now. Why does this bias exist? Is the second one is we hate feeling late. So whenever we buy a stock which has already run up or is in the process of running up, we feel that we are late and that we have missed the bus. So, for instance, you're going from point A to point B and you're taking a bus and you miss the bus at point A, and you know that there will be an interim stop 10 kilometers later and the bus will stop there for 10 minutes and you can reach it, uh, you know, on a bike or in a car. But this feeling that, we got late, stock moved, let's wait for another one. So, being afraid of being late uh, causes us sometimes the bus to leave actually. So here, for instance, in Varun Beverages, if 50 rupees was thought to be late because it rose from 20 rupees to 50 rupees, in the next few years it went to 100 rupees. You thought it is very late, then it went to 300 rupees. You thought it is very late, and then it went to 600 rupees, and we missed the entire rally. So the idea should be that we should be able to get in. Getting in should not be a major resistance point. Getting in should not be, it's like, I know the bus is moving in my direction, let me get onto it, even if I have to run and catch it. And then if I know the bus is going to stop or is not going further in my direction, I'll get off. So the plan to enter should not be very difficult. The plan to exit should be very sharp. Point three here in this bias is that we think waiting gives us control. So this control element is also there in our psyche, where we want to control things. I want this stock at this price because I think the valuation is so and so, or I saw this price 2 months back. I want to buy it at this price. Now the market doesn't owe you that price. The market is flowing as per the liquidity flows into that stock. If more people are willing to buy it at 30 while you are waiting at 20, nobody gives two hoots to the buyers at 20. You may get lucky if market overall breaks down, there is some panic and that stock is available at 20, you may get lucky. But in the normal course, waiting, perhaps it will only satisfy your ego, that I waited and I was able to get the fill in 5 years of waiting. So buying cheap By waiting gives us a degree of satisfaction, but that is, we have not come to the market to achieve satisfaction. We have come to the market to make money. Let it be very clear what is the goal here. So let's say you wanted to enter Nifty next 50 here, but you know it would be better if there was a 25% correction. The index has already gone up from 18,500 to 33,000 within a matter of a year and a half. Let's wait for a 25% correction. That 25% correction never came. It went up another 2x from there, in the next 2 3 years. But yes, some 25% correction came at some point of time, but you missed that entire 100% rally waiting for a 25% correction. So that, I mean, if you bought here, it may give you the satisfaction that yes, this was 78,000, now I bought it at 62,000 and I bought it at the bottom. Fine, you did a great job, but you missed this entire rally from 32,000 to 62,000. The next point is we tend to associate price with risk. So in some ways, a higher price does not mean higher risk. This is also in our mind, uh, that if price has gone up, then risk has gone up. So there basically, perhaps is not so much risk actually when you're entering near or at highs. As I was mentioning earlier, if you will take 100 stocks which are near their all-time highs, you will find there's a high probability that a significant proportion of them will actually continue to go higher. So the risk at that point actually was lower, and there is a science behind that. So the idea is that there should be a solid emphasis on having a sound exit plan. Wherever you enter, you may have entered Infosys after it went from 1 rupee to 7 rupees in just a matter of 2 years. This is all adjusted prices. So just look at the kind of rally it had from a single rupee to about 180 rupees in 4 years. Can you imagine that? 180 times in 4 years, and you're catching it in the middle. And if you were able to catch it in the middle, you would have gotten out somewhere. Then you would have gotten it here somewhere and ridden the rally later on. So understanding that why a stock which is at all time high is not so risky is because there is no resistance left in that stock. Anybody who would have bought this stock in the history of that stock's journey has not bought it at any price higher than today now. So let's say stock is at 100 rupees and it is at all time high. It means that everybody in that stock today bought it lower than this. So there is no inherent resistance in the stock. Usually what happens, somebody has bought it at 120, somebody has bought it at 110, now the price is 100. So whenever it will come nearer to 110, 120, those blocks of buyers will jump to get out at their even cost to even price. At an all-time high, a stock is like a free bird. There is no upward resistance. It can go as high as possible. So, what biases feed this kind of thinking? First and foremost is anchoring bias, where you anchor yourself and your mind to a price that you have seen earlier. I saw it at 400, now it at 650. I can't buy it now. It's too much. The stock may be going to 5,000. Loss aversion, what if I buy now and it crashes tomorrow? Well, any stock can crash tomorrow at any from any price. So it is not that if the stock price has gone up from 400 to 650, then that stock only has to crash. Then of course the narrative comfort is there. The fundamentals don't justify this move. Well, fundamentals probably don't justify any stock in the market right now. But the market doesn't, wait for fundamentals. Market is built basis what flows are coming towards the market. So this waiting for clarity business that the TV will tell you, or all analysts on TV will tell you, please wait for clarity. Please, there is never any clarity that's going to come in the market ever. There is always going to be some confusion. There is no clarity. If there was clarity, it would be utopia. There would be no price change. It will just go from one price to the other basis. Uh, whatever changes in the company that are happening. So the magic portion to solve for all these biases is the anti-momentum mind is essentially to go with momentum investing. Momentum doesn't care about comfort. It just basically follows very, very simple rules. It follows strength. It identifies which stocks have strength, which stocks are weak. It gets into stocks that are strong. It gets out of stocks that are weak. That is all. There is no mumbo jumbo about 50,000 variables that is happening there. It is all about how the masses are coming together, how the flows are coming together and creating price behavior. The system does not ask that is this too high. It simply asks is this outperforming now or not. So momentum stays in the winners, stays on till they are working and gets out whenever it is not working. There is no emotional connect with the stock. There is nothing like, I will not buy, I will not sell this stock forever. I'm going to die with this stock. There is no such emotional connects with any stock. And once a stock has made all-time high, you never know. It may be that one multi-bagger of your life that can take your portfolio from one level to another. Just one or two stocks can do that. There are so many more examples, but for paucity of time, I just take a couple of more only. Uh, Tata LXI, for example, from 1999 top till 2015, for almost 16 years, this stock did not make an all-time high. And when it did, it went 6x within a matter of 9 months. If you thought this was expensive, well, this was also expensive, but you still made 6x. Then it plateaued again for the next 3 4 years, perhaps 5 years, and then it did another 6x. So if you participated in portion here, some portion here, that was good enough. You need not have followed the stock for 25 years. If you participated in a 3x move here and let's say a 3x move here, that's good enough. And you would have used your money elsewhere as a opportunity cost for that. So key takeaways here: you're trained to look for discounts in a bazaar, in markets, even for cheap narrative to become a success. You need momentum. Momentum is pervasive. Please understand this. A lot of people will keep beating the momentum concept. Even when you are identifying value, that stock needs momentum to go up. Please make a very clear distinction that there is nothing called a momentum stock versus a value stock. It is just a matter of how you are identifying it. If you are identifying it basis value, it will still need momentum to go up. If you are identifying basis price movement, you are already identifying momentum. So the job is not to feel smart that I bought low. The job is to follow what is working, how you're making money, and to exit losers when you have to. So in the ideal world, I would like everybody to break free from this anti-momentum mind. Trust the system, trust the price, and trust momentum. If you like this video, you will also like this other video, which is about the human behavior. It's you versus your system. Please click this and watch this video also. Now let's get to the market action for 31st of July. So we are at the end of the month, a tumultuous month, I would say. Flattish to start with, and then Mr. Trump rocked it again last evening by saying that India is going to have to pay 25% tariffs plus penalties for being friends with Russia. And as a knee-jerk reaction, market opened lower, but then realized that Trump always does a second move, and perhaps this is going to get rolled back. And then expiry day moves also in the market, and then it slumped again. So a very volatile day. Please do like and share these videos if you like the content. Do subscribe to the channel as well. So Nifty closing down at minus 0.35%. I think this is much better than what anybody expected before the day's start. The markets actually almost at the low being the open of the day, just like it did 2 days back, which is always good signs that potential bottom is there, just like you can see here as well. Whenever markets gap down and that opening is the low of the day, that is a good probability that markets have bottomed right there. But of course, we can't say here because it's a developing story that goes on. But nevertheless, a good outcome for the day, I would believe. Nifty down minus 0.35, Nifty Junior down 0.5%, mid caps down 0.83%, more damage here, and small caps also down 0.91%, some more damage here. Bank Nifty very smartly coming back and closing only 0.34% down. At one point, it was down almost a percent. Gold up 0.92%. Gold is hovering around that breakout mark. One day it will just fly. That's the kind of gut feel I have. Advanced decline trends, declines were declining till the second half of the day, till about 2 p.m. And then there was a shock to the system. Perhaps it was an expiry shock. We'll come to know tomorrow. And the advances were gaining till they gave up some of it. So weekend, of course, for the entire day, a close that was not strong but weak. 127 to 374 advanced decline ratio. And you can see the Nifty heat map is mostly red. Geofinance on raising of new funds is green, and Hindustan Lever's post results is green. Adani Enterprise, Sun Pharma, Reliance, State Bank leading the market down. In the Nifty Next 50 space, you have some green: Indigo, Hyundai, United Spirits, Godrej, CP, several of them basis results. But Ambuja Cement, Zydus, PNB, LIC, some of these stocks were going down. In the movers of the day, HUL was up 3.5%. I think sales are up 4%. Profit has risen 7%. I don't see much reason to celebrate so much. But overall, I mean, the stock has not gone anywhere in months and years. But yeah, I mean, for a good balance to the market move, HUL saved the day for the Nifty. IOC down 2.29%. So several oil refiners were down. There is potential supply chain problem versus Russia coming up. If they were to not get Russian oil or not choose to take Russian oil, then that can be a problem. And IOC was down basis that. Sectoral trends, only FMCG basis the levers result was up 1.4%, and some other FMCG stocks also were in a defensive mode, going up slightly. But major damage: oil and gas, capital markets, pharma, metals, and commodities all down 1% to 1.48%. So overall, a significantly negative day. These are some of the stocks in the oil and gas space that were beaten down, and we have now come back to the May levels on oil and gas. So another sector that has uh, not performed at all. FMCG is also back to where it was perhaps beginning of May, and we can see that it has been going sideways since a long period of time. Imami, Godrej, Levers, United Spirits, and Dabur, some of the stocks going up. This is a video that we did recently on you and your system. You may want to watch this. Do click it now and do subscribe to the channel if you haven't so far. Do let us know how you like today's content, and do give us more ideas. Tell us what you don't like or do like about these videos, and I'll see you in the next one. Bye.